Hello, everyone. I'm Laura Greiner, your host for today's Swine podcast. And with me today, I have Joe Kerns, who's with Partners for Production Agriculture. Joe, how are you doing today?
I'm doing well. Thanks for having me on the program. Thank you.
We're excited to have you here today. I know we have a lot of things to talk about. There's certainly always lots of things going on around the world that influence swine production. But before we get started, maybe for our audience, if you could do just a brief introduction about yourself and what you're currently doing, I think that would be great.
Sure. Recently we just went through a transition here, and so the company that we had started back in 2008, after being in corporate agriculture for 25 or so years, we recently were acquired by an entity called 𝗹𝗶𝗹𝗹, and really what this does, it allows us to leverage a platform of what we do onto a broader spectrum. We were really good at the fundamental components of our industry. We were very poor and perhaps behind on the technological side, and kind of adding that technological side. There's a few transitions that occurred of the why behind the what, but I'm really excited to have a broader platform to push against for the application of what we do, and that's look out for the best interests of pork producers across the United States.
Wonderful. Yeah, I heard that acquisition happened. I just wasn't sure what our official title was yet today.
Yes, yep. And we're going to go through a trend. We'll still be PFP Ag for a bit here. It'll eventually transition into a broader platform under the 𝗹𝗶𝗹 umbrella.
Perfect. Well, that sounds great. And I know you've been an integral part of a lot of production companies and independent producers over the years, doing exactly what you said, helping them figure out where markets are going to go, how to protect themselves against the price fluctuations that we anticipate. So let's just go ahead and jump in today. Let's first start with the first and foremost thing. I saw a set of diets this morning, and there was a little bit of sticker shock. So let's talk about grain prices and where are we headed?
So we've already kind of, that horse has been out of the barn here. We're trading well over $8 corn in the cash, whether it's Central Iowa. It doesn't matter where you go. So I was just before joining in, I was on the phone with an elevator manager who's offering 70 over corn into Central Iowa for the summertime, and that's over the July, and you've got the July DC inverted by 40 cents. So that's the same thing as well over $1, and that's in Iowa. We're not talking about Texas or the Carolinas that are accustomed to those type of values. Once you get down there, they're literally $2.70 over. So we've got a freight logistics snafu that we're dealing with. This has been exacerbated, of course, by what's going on over in the Ukraine with the Putin invasion and some uncertainty of who's got access to grain when. And it's probably a very natural human reaction that we as a society tend to hoard in times during unknowns. And so we're starting to see that mentality play itself out in the grain markets, and it's manifesting itself into, as I shared, corn over $8 a bushel, new crop corn trading in excess of $7 a bushel. It's a boon to the U.S. agronomic sector. It's going to be a bit of a challenge for anything dealing with animal agriculture, and specifically in the hog market. Yes.
Mm-hmm. Absolutely. And how do we think that's going to look going forward? I know we haven't had a recent USDA crop report, but what's kind of the anticipation for the coming fall?
Well, we just did have a crop report on Friday. It was so generic that most folk missed it. And it basically, we didn't change anything on the production side, made a few tweaks on the demand piece, but really the growing season is where it'll all come together. The USDA uses a regression that's a 5-point regression that has an R squared of over 0.96. So these 5 items really encapsulate what the corn yield looks like. And of that, the vast majority of the emphasis is placed on July precipitation for corn and August precipitation for soybeans. That's not a huge shock. And so we've still got to play that out. We are as close to normal as humanly possible as far as planting progress is concerned. We got our first bean condition report out last night. We're very close. It's actually a little bit better than average as far as the conditions are concerned. We've got some very warm temperatures over here for the next 2 weeks, which quite frankly will be welcome given the amount of moisture that we've had. The problem is going to be if this persists past the 4th of July, and this pattern does look like it's set up for that, for this ridging system to set itself up in the western Corn Belt, and we could see a replay of what we saw last year. Last year we got off to a fantastic planting start, had a very even crop, and we were able to sustain some poorer weather during the heart of the growing season. This year we're a little more uneven, mind you, as far as our start was concerned, and so it'll be even more important, especially after that drawdown of subsoil moisture in the western United States, that we have something that resembles a normal growing season to give us someplace in the neighborhood of 180 bushel national corn yield. And Laura, the real story isn't even what happens this year, it's what happens 2 years from now. And we'll talk about that, I'm sure, here in a little bit, about the advent of renewable diesel and kind of some of the unintended consequences that are going to be facing agriculture with a capital A, both the agronomic side as well as the livestock sector rolling forward here.
Mm-hmm, absolutely. And you hit the nail on the head. My next question, we were talking about corn and soybeans. Yes, they need the warmer temperature days, and we're getting that now. So really expect the soybeans to take off. But that is something that we're talking about today in hog production is, do we anticipate that the soybean prices are going to plummet? And what does that mean for us in terms of, obviously formulation, but of course, long term, if we start using more soybean meal, we don't use as many feed grade amino acids, we have more nitrogen in the manure, we have more land mass needs. So let's talk about that a little bit. And let's start with soybeans, and then we're going to jump over to fats as well. But let's focus on soybeans first.
Okay, all right, and you can't separate soybeans from fat because of the oil content.
Right,
so those two things run in a very consistent fashion, and you have absolutely properly identified the controlling factors here. So let's talk a little bit about this. Is you've got something called 45Q credits that are carbon sequestering credits. That you can Google that and look that up, and that's the underpinning of everything that we're seeing. When I say about everything we're seeing, it's this explosion that we've witnessed in the processing community's expansion. And this is your normal culprits. This is the ADMs and Cargills of the world, but you're also seeing other entities start to enter that fray. And we've not seen this, and I mean this literally, is we've been processing beans pretty much the same way since the 1930s. You give them a hexane bath, you withdraw the oil, you apply a little bit of heat. Hexane has a very low boiling point, and so you recover it, and you skim off the crude. It's not a hugely scientific process, but it's a very predictable one. But we've not seen entries of this many plants in a given time frame, nor the players being as diversified. And every single one of these players is identified with a petroleum company. So it's whether it's Phillips 66 or Chevron or Marathon Oil. And that's your hint. And this is where it comes back into play on the fat side of it, is the driving factor of the revenue in order to create renewable diesel. And economically, it does work once you've got these 45Q credits laying behind you. And what happens is ostensibly in 2 years, not only are we going to have just a little too much soybean meal, we're going to have a lot too much soybean meal, to the point where I am under the impression and of the belief system that we're going to be feeding soybean meal for the energy value. And in most rations, energy value is roughly 92% of corn on a per ton basis. And just for your audience, $6 a bushel corn is the same thing as about $200 a ton. Just to kind of get those relationships in your head. And so that would mean that if I'm anywhere close to right, that at those type of values, that soybean meal will be trading at less than $200 per ton, which is, if you'd have a normal circumstance, that'd be a very welcome situation for animal agriculture, and for the pork market specifically, not so much if you're an amino acid provider, because you're going to have, I think, a real tough row to hoe here coming up. But it does do exactly as you indicated, is we're going to have more nitrogen loading inside those pits. We're going to need more land for application. And again, it's this whole cascading of what I called unintended consequences. I recently had an opportunity earlier this year to be at a meeting in Washington, D.C. with policymakers, and I may have shared this with you even, that there was two things on the agenda, how to regulate Bitcoin and what to do with carbon markets. And the carbon markets then lead into the larger displacement with inside agriculture. That's kind of where I identified. Here's what I learned. Nobody has any clue what to do about Bitcoin, and I'm not sure it matters after yesterday. It's lost 60% of its value since the high, and maybe nobody wants to touch it. But the SEC thinks it's an equity. The CFTC thinks it's a commodity, and so both sides are kind of wrestling with that. But the carbon market situation and its impact on animal agriculture specifically was fascinating. And if you when you run these regressions, you can't just let everything float. You got to hold something steady so you can push against it. And that's why I chose to use at that point in time corn at $6 a bushel. If I had to redo it again, obviously we'd use much higher prices, but it all moves in relationship to one another. But I do see 2 years from now specifically, if I'm anywhere close to right, domestically we're going to be producing about 40% more soybean meal than we are right now, of which we can incorporate roughly 20% back into our diets, and we're going to be surplus and have to export the balance of it. We logistically in the United States are not set up very well for deep water exports. Some very enterprising companies are building some ports as we speak right now, and I think that's very wise on their part. Just a little bit of a statistic is Argentina is the #1 exporter of soybean meal across the world. They export about 40% of the world's soybean meal, and we produce about 2x what the crop is in Argentina. So the Argentinians are going to start to get a run for their money here soon, just because of our surplus. The value of the Argentinian peso in relationship to the U.S. dollar favors them, not us. But necessity, in my opinion, is going to be what drives our needs. We're going to have to move this product. Let me circle back on one other thing here, Laura. Is that soybeans are not the most efficient producer of oil. That if you take a look at, they're about 17% oil or so. Canola or some of these cannellina, some of these other crops would be much more conducive. The problem being is that the byproduct, the meal product, canola meal or whatever, has some anti-nutritional factors. We as nutritionists generally know what to do with soybean meal, whereas the surplus of these other byproducts wouldn't be utilized, and so therefore the economic benefit backs off. Right now, renewable diesel is constituted by about 50% soybean oil. If I'm anywhere close to right again, in 2 years, that's going to be about 75%. So we will be a major player in the energy markets for the foreseeable future.
Mm-hmm. Yeah, one of the other things I've heard, or at least some concern that I've heard out in the field is really around, are they going to pull more soybean meal, are they going to pull more soy oil out of that soybean meal than what they currently are? Again, thinking about distillers, right? We had the distillers process. We were probably producing about 10 to 13% crude fat. Right. Now we're down to, 4% or so. And so that's the next question is, do we think that those methods are going to pull more? So then again, energy isn't going to be equivalent soybean meal to corn.
No, so you're exactly right. So let's kind of go through just a little bit of math on this. Is that right now fat is worth someplace in the neighborhood of 75 or 80 cents per pound, whereas a pound of soybean, let's take DDGs, a pound of DDGs at $200 a ton is was that 5 cents a pound is what that's running. So you can see there's the economic motivation for the processor to pull out as much oil as he can. Here's the good news for those that are concerned. They're already doing it. The economic incentive is already there. We can get down to a little less than 1% residual oil left in soybean meal, about the same in DDGs, just with some centrifuges. There's 2 different methods of extraction, mind you, that you're utilizing in those processes, but I really don't see it changing. We are in a low energy feedstuff environment, and we're not going backwards, but as far as those 2 are concerned, they can't get any lower than what they're currently doing. They can add back a little bit of fiber on the soybean meal side, but I don't even see that happening.
No, and certainly that's kind of the approach we're taking, is we're as nutritionists thinking about, okay, we've got to go back to fiber. We need to look more at the European model, because as you mentioned, fat's 80 cents a pound, and we do not anticipate that coming down again with this renewable diesel project.
Okay, so let's put this in a broader perspective. In 2021, the United States produced 26 billion pounds of soybean oil. in 2 years for renewable diesel commitments that we've got, and this is refineries that have already been built. So you've got or under construction or going to be built, is we're going to need about 21 billion pounds. So just give me some rounding error. It's about a 1-for-1, which means we're going to displace every single pound of fat that's utilized in the United States, whether it's McDonald's fries and cooking, whether it's the Crisco on the shelves at the Fairway store, it doesn't matter, or what we put into a swine diet. So everybody is going to be in a dogfight, and these things generally don't end politely. That we don't have the rationale of saying, "Oh, I can see the end game, and you're going to outbid me, therefore I'll just step aside." That's not how it works. We sit and fight and fight and fight, and then capitulate and give up. So I'm under the impression that the soybean oil price, even if you say it's going to settle out at $1 a pound, arbitrarily, just making up a number, it probably goes to $1.50 a pound first before those struggles have the economic consequence to bring us down to where equilibrium lies. We will swing the pendulum too far, wherever that is. And so I think your producer group thinking about what does a low energy diet look like and do so upfront and kind of internalizing that is a very, very wise decision. Very wise.
Absolutely. Well, I think that's very good insight on exactly what we're looking at on the crop side. Let's flip over and let's talk about pigs. So let's talk about June hogs and the pig reports and where are we at today?
Sure. So if you talk about June hogs are going to be actually going off the board today, so your timing is pretty good. And they're kind of going off with a little bit of a mild thud, I suppose. Is we traded up to $120 per hundredweight. We pulled back to less than 100, and we're going to close 108 plus or minus someplace in that neighborhood. The March hogs and pigs report would have indicated that we start to get some thinning numbers here as far as harvest is concerned over the next couple months. As you stated, the June data was collected over the past 2 weeks here. We'll be presented with that at the end of the month, and I'm expecting kind of a wash, rinse, repeat of the exact same thing, where our sow herd is not growing much, if any, whatsoever. Our production difficulties that we've had outside of the farrowing barn continue to plague us across many different enterprises. Geographically, it doesn't matter. Once you get into those hog-intense areas of northwest Iowa or the I-90 corridor in Minnesota, you kind of learn to live with that. But we're seeing this across a larger geographic influence. I say that because I still fully anticipate that we're going to see hog kills of less than 2.3 million head per week in the month of July and rolling into August, which probably leads to a little bit of optimism as far as the price outlook is concerned from where we sit right now. Now, it sure doesn't feel like it. We were talking before you started the recording here about what's going on with the stock market that just got slapped around silly yesterday. And it tried to rebound early today and just can't get its feet underneath it. And to think that we're not getting some negative pressure coming back from the sentiment inside the equity market would I think be a little short-sighted. Pork should represent a very fine value competitively. The world feels like it's dissolving here when we've got a 20+% off on the S&Ps, but we're not. We're still the wealthiest nation ever, and the vast majority of folk are going to do fine, and pork should find some footing even in a kind of a more compressed type of economic environment rolling forward here. So June hogs and pigs report, I'm not expecting any fireworks. I would think that you would see some plus or minuses in an incredibly narrow range. And by the way, coming out of COVID, boy, is that ever welcome, because during those times we had no clue where things were going to be. And so boring is actually good in this particular case. I'm okay with boring, but I would see some opportunity for price appreciation, especially given the cost of production, is we're not seeing a whole bunch of expansion, ASF at the doorstep, unknowns as far as Prop 12 is concerned. We have a very tepid environment for aggressive expansion. I do think you're going to see some replacement, and I wouldn't even call it net expansion per se. And then focusing on herd health is, I think, the next biggest challenge of the industry.
Absolutely. What about, so of course, summer hogs, we usually get a higher price, and as you mentioned, numbers are down. What are we looking at for third and fourth quarter this year?
Well, I'm still optimistic. So a lot of us travel up to the Wisconsin Dells in the middle of July for the NPIC meeting, and that seems to kind of be the top of the market. And I think we're going to see a repeat of that. That's going to be kind of our the third week of July or so would be our thinnest harvest week. Probably hangs in there through the month of August. A replay back to $120 plus is not out of the question by any means whatsoever. And even coming into the fall, we probably start participating in some protection at $95 and above in the October and kind of holding ourselves together. But keep in mind, $95 hogs in October, traditionally, you'd say, oh, that's unheard of. Well, that's we're going to be encroaching on cost of production very, very soon. I've not taken a look at Lee Schultz's model here recently, but we've got to be 90 cents plus on a carcass weight for the average producer, if not maybe even for the good producer. So I think that a dollar is not what it used to be. Dollar hogs, we've only traded June hogs. Guys, we've only taken June hogs off at over a dollar twice before what's going to happen today. So we got to kind of keep these things in perspective. We are in positive markets. Our input costs are mitigating some of our profits, but I want to keep everything in perspective, and that's really what we've been advising our clientele to do. Is during times of margin management, when we've got so many unknowns that are playing out in the world, of when you get an opportunity to hedge a profit. And I'm a huge fan of the insurance program that's subsidized by the government in combination with some option strategies, is I think that we owe it to ourselves to take advantage and to shrug and admit, I don't know, that there are so many moving parts that I don't know. When I was down at World Pork Expo, we had a little bit of an interview, and I challenged the group. I said, if you would identify what is the most important market moving factor that you have, whether it's when the Ukrainian-Russian situation is going to be over and how it ends, whether it's what U.S. production is going to be, and you had that one snippet of information that you deemed to be the most important, would you bet on it? Huge sums of money. And the answer had better be no. The answer had better be, I'd place a couple shekels out there, mind you, but I'm not going to bet my 401k or my life savings on that one nugget, simply because there are so many moving parts and they shift about who is taking center stage at any one given point in time.
Mm-hmm. Absolutely. And you alluded a little bit there to risk management. I think it's a really good discussion point. You talked about hedges and options, of course. And so let's talk a little bit about that, because obviously we're talking about raising production costs, maybe some, obviously holding steady on the prices, maybe a little bit of fluctuation in the fall to maybe hit right at cost of production, possibly not a profit there in the fall. So let's talk about what we can do to try to mitigate some of that that's coming.
Well, I think that you kind of summarized it there. It's understanding what is my cost of production relative to that forward curve of revenue, and then instituting those practices. Earlier, I just referenced what goes on with the insurance side of it. And for the listeners that you have that have not participated, I would highly encourage them to take a look at the insurance programs. They've been around for quite some time. They're administered by the same agency that does crop insurance, and most of us are very comfortable with that. The way that they're calculated is very different. So I want you to have someone that understands options, because if you don't understand agricultural options, you really don't understand insurance. The beauty of it is it's subsidized up to about 50% is where kind of the sweet spot is relative to the cost of an option, and you don't pay for it until after you market your animal. So it's a cash flow consideration. It is a wonderful, wonderful tool. The dairy guys had this for the past 2 or 3 years. Hogs in the cattle sector picked it up in 2020. There's some enhancements that are going to take place in July of this year that make it even better. So the tools at our avail are coinciding with the time frame where we really, really need them, and that's not a normal thing. Normally we have a crisis, then a response. We actually have the response to the crisis happening coincidentally, and I think that's a wonderful thing for pork producers.
Mm-hmm. Absolutely. I agree. The other thing that, while we're talking about markets and certainly pig pricing, that I heard a lot of discussion while I was at Expo was really around the pork cutouts and what's the future of this and where do we think it's going to go?
Well, it's fascinating because the pork cutout came out with a lot of fanfare. And let's back up just a wee bit. is we rolled out the pork cutout back in 2020 in the throes of COVID. And the logic before that was that the CME took a look at the volume, and most of the lean hog volume that we have is concentrated into the first 3 months. We're relatively short-term hedgers. Food service was clamoring for something 6 to 12 months into the future, and they thought, well, how about this? We've got this nearby issue. If we combine that with something that's looking for a little bit longer term, that these two can work in conjunction and not pirate from one another. Throw in COVID and suddenly nobody has any forward projection that is worth a hill of beans. And I don't blame the food service guys for not participating, nor do I directly blame the CME. I think the timing was absolutely pathetic in order to put that together. The contract itself is solid. The contract itself, it's good cash settlement. It's going to be familiar with pork producers that it coincides with the months that we already trade that line up with the lean hog trade. Also, the problem is the volume, is that we just have not seen the participation. We've got something called market makers that are generally paid in order to put a bid-ask spread together that's relatively tight. That seems like it could use a little bit of improvement also from the CME. But the bottom line is that our level of participation, even at its peak, was somewhat less than overwhelming. And even when I was taking a look at it coming downstairs, is we've got zero volume in the June today. Now, it is a cash settlement, so it's not going to be a crisis, mind you, as far as the settlement is concerned. But we've seen very, very low volumes on a consistent theme. Whereas I want to say open interest yesterday on the June pork cutout contract was 360 contracts, and where the lean hog contract was over 10,000. So it kind of gives you a feel of the magnitude of participation. So as long as we've got open interest, the CME cannot shut down those particular contracts. We had a pre-World Pork Expo event, and we did have a representative from the CME there, and they're reaffirming their commitment to the contract. And I would encourage your listeners, if they have a cutout-based price discovery tool, that they continue to participate. Here's what I don't want them to have a fear of. I put on a contract, and all of a sudden the CME says it is no longer. They can't do that. They can't do that. So you're going to have convergence. There's not a delivery piece that's associated with it. It's a cash settlement. And so I think that you can enter into these with a fair assumption that your financial risks are going to be covered. But in direct answer to your question as you posed it, the pork cutout has been disappointing. And maybe I could use a few more adjectives, but we'll just leave it with that one.
Yeah, let's leave it there.
Yeah.
You just threw out a word for me, Joe, or a phrase there that maybe we should talk a little bit more about. You used the word price discovery.
Yes.
So as producers are using price discovery. So let's talk a little bit about price discovery, how you view it, what's good about it, what's maybe not so good about it.
So let's talk about what's been troublesome to our industry, and that is that we use this kind of almost open outcry side of it on the negotiated piece in order to price everything else that's on a formula. And through nobody's fault, when we went through some very difficult times, specifically 1998, that if you wanted money for an operation, you were more than likely going to have a contract that did not reference something that was going to be Iowa, Southern Minnesota negotiated. You were going to be a Western Corn Belt plus at the bare minimum, maybe a cutout contract that were becoming in vogue at that point in time with mandatory price reporting, a basis contract. There's cost of production contracts, and they've all kind of rolled around. Once we hit a saturation of shackle space, these open market discovery contracts have proven to be very, very troublesome for the pork production industry. As we saturate out the shackles, and again, this is not nefarious. This is just economic reality that the packer doesn't need any extra hogs, and so we push down. The market signal is very compressing as far as price is concerned, and then that price is the other 97% of the market. So we've had thin volume. They've been relatively compressed as far as the price discovery relative to another methodology, mind you, up until recently. So once we've got shackle space and pig supply in what seems to be a pretty good balance. As a matter of fact, I'd argue that we're short pigs, and I think you can prove that out, given that we're trading $120 pigs in the cash, and you got the cutout at 108. That's not a great long-term solution. It might feel really good for a little bit of period of time, but we as an industry need the packing side also to remain profitable to continue on here. So there's got to be some level of give and take inside here. I'm still a fan of the cutout contract long term, of indexing our future to what the meat side of it is, and then relying on the National Pork Board and the National Pork Producers Council in order to look out for our best interests. And both of those groups, I think, do an excellent job for pork producers. But I think that's where we're going to have to shift to, what we just talked about, the pork cutout contract being less than heavily participated makes that a difficult shift. But I would still encourage folk to take a look, whether it's cost of production, depending upon what your finances look like, a basis contract, depending upon your comfort level with Chicago Mercantile Exchange processes, or a cutout contract. That there's some mix inside there that should remain viable. Here would be my caution. If you're on a Western Corn Belt or an Iowa, Southern Minnesota market, it might feel really good right now, but I think there's some trepidation and some danger that will occur if we ever start to see a shift of animal supply relative to shackle space. And even when you had the Smithfield announcement earlier this week that they're going to be shutting down that Los Angeles facility, that is a loss of shackle space in our industry. So that's kind of a little word of caution. I don't think that one's going to be near as important if it would have been something more central in the United States. But just numerically, is we are going to be losing shackle space relative to our animal supply. Now, it doesn't occur, I want to say, for another 6 months or so. It's sometime in 2023 when that occurs, but you can kind of see the writing on the wall.
Yeah, absolutely. We have time for one more question, and I really want to kind of wrap this up. We've talked a lot about pricing and shadowing and where we're going in terms of forecasting, but let's talk just briefly about what you view as the key metrics, if you will, or the key things that pork producers do to be successful relative to others in the group of pork production.
So we're not going to get too far off the beaten path here, and I think it's the revenue side is the driver. And let's put this in perspective. I went through an exercise recently. I said, what happens if we double the price of corn, that it goes from $7 to $14. And what does that mean? Well, that's about a $70 per hog negative coming back to you. What happens if we double the price of soybean meal? That's about another $35 or so. Well, what happens if we double the price of hogs? That's $200 more that you get. And so just to kind of put all of this stuff in magnitude in an ordinal fashion, if we get the revenue side of our industry right, is the most critical component. And if you don't, you can be almost perfect in every other segment and still not do well. It doesn't matter what your farrowing rate is or what your feed conversion is, that if you're not getting the revenue, you're probably not going to be long-term successful. And so I beat the drum on this one. It's not just because the industry that I get to deal with all the time as far as the future side of it, but also economically, it mathematically proves itself out that the best producers are the ones that are getting the most money for their product. The price of corn falls definitely in the top 10 someplace, but if you said I had to be right on one market, I take the hog market every single day, several times over, is really where that's at. And then we've got to be our animal husbandry skills inside the barn, are paying attention to what's going on as far as changes. You initiated this with the soybean meal, the lack of oil that's coming at us. Don't be afraid. I would let your feed conversions escalate just a little bit. Feed that lower energy diet, because that's going to make you more money, and making more money is a part of sustainability inside of our industry.
Mm-hmm. Perfect. I think that's a beautiful summary especially of what we've talked about today. So I'm going to kind of jump over now, Joe, to some more of our infamous questions that we like to ask our guest speakers. The first one is do you have a swine resource or a reference that you would encourage producers to look at?
You got some readily available stuff. Even the DLR that comes out. I think those guys do an excellent job of providing a short recap, a one-page and easy read. We push out stuff to our client base on a daily basis, and I'm going to give a shout out to one of our gentlemen, Steve Ring, who gets up at 3:30 in the morning to start doing market research and putting items together for the clients that we get to work with. So I think you've got a myriad of resources that your readers and viewers get to have access to. I don't think there's just one thing, but it's paying attention to the influence of macro markets on what it means to our markets also, and keeping these things contextualized, and then seeking out help in order to put kind of some weighting on individual events and what that means to a producer's bottom line.
Mm-hmm. Perfect. How about something that's not related to pigs? Are there any resources or books that you'd recommend?
I'm an avid reader of the Wall Street Journal every single month. By the way, I still get the paper edition, given I am a child of the '80s, perhaps. So that's still. But I still think being cognizant of world events, availing yourself to people that don't look or think like you do on a routine basis. It was funny because the weekend after World Pork Expo, we had a big party out at the house, and then that next weekend we had 17 Harley riders in from various parts of the world, and it was fascinating. It was very fatiguing, mind you. I was happy when everybody was gone, but it was also availing yourself just to somebody that doesn't look or think like you. It might make you a little uncomfortable, and that's probably a hint from inside you that you need to open up your world to make it just a little bit bigger than perhaps what it was. From a business book perspective, I'm a huge fan of Angela Duckworth wrote a book called Grit, and maybe because it resonates with me. You don't have to be the smartest one in the room. You just have to keep trying and keep going. By the way, I was somewhat less than a 3.5 student at Iowa State University, so that I like it that you can overcome the lack of intellect with just the determination, the staying power.
Well, you're definitely viewed as a very smart individual, Joe, so I wouldn't let that GPA be held against you for any reason. Well, the last question we like to ask is really around, if you can think of somebody in your life that you've defined as successful, what's a key trait that they've had that you think's allowed them to be successful?
So I'd have to point toward, I think, our mutual friend, Dr. Howard Hill. And Dr. Hill and I worked together at Iowa Select for several years, a great educational opportunity. Howard is well regarded not only for his financial prowess, if you call that success, but I think he's a life success in the way that he holds himself, the way that he is a teacher and a mentor. And Howard will stop into the office maybe once a month or so. And he is never afraid to say, I don't know. Tell me about this. How does this work? And we'll walk through things. The other part that I think makes Howard very, very successful is every time he comes into the office, we'll have breakfast, and every time he comes in, I pay for it. Howard doesn't spend any of his own money, so he's done well generating all kinds of income and then holding on to it too, and he will deploy it for those that he loves. He takes very good care of his family. He is a genuine lifelong learner and lifelong teacher, and I love him dearly. I think he's great.
Absolutely. That's a great one. I really appreciate that, Joe. Well, we do want to thank you for your time. I know as you got on, you're pretty swamped today with some different things, but again, great insight, very valuable information. We appreciate the time that you had with us today. And for our audience, just a reminder, this is Joe Kerns, who's with the Partners for Production Agriculture, or now EverAg.
Yes, ma'am.
So thank you, Joe.
All right. Thank you, Dr. Greiner.
Imagine if, with a few key concepts, you could have the potential to create a massive positive impact by bringing from hundreds of thousands to millions of dollars for swine producers. Join us on this small group and go to the next level of swine nutrition on this 7-week-long elite online training in applied swine nutrition and feeding by myself and my world-class invited speakers. Additionally, you enjoy an exclusive community to exchange ideas. Go now to www.eliteswinenutritionist.com.